Greetings and welcome once more to another discussion of FAC2602. In this discussion, we're going to focus on, so this is assessment 4 of semester 1 for the year 2024. All right, so this is more like the final exam, although currently going forward, the final exam will also include other aspects like investment in associates and joint ventures. Now we're going to focus on the question number 3. So question number 3 has to do with cash flow statements. Right, so we have question number 3. So question number 3 was for 25 marks and 45 minutes. So the general advice that we give you is, please try to stay as much as possible within the allocated time frame. Because if you move to the next question, you stand a better chance of collecting easy marks than staying in one question and you struggle to get the last remaining marks, which are probably more difficult. All right, now we get started. So we go to the required. The required wants us to prepare a statement of cash flows, and we must use the direct method. So if we can just talk briefly about the structure of a cash flow statement. So our starting point is cash flows from operations. Then we go to cash flows from investing activities. Then we go to cash flows from financing activities. Now, the investing activities, the financing activities, the structure is the same for both direct and indirect. The structure is the same, right, for both indirect and direct. So when they say prepare according to the direct or indirect, it's about a certain section, a particular section of the operating activities. Right. So in the operating activities, we have a section that is called cash generated from operations. Now, this is the portion which we can present using the direct or indirect method. Right. Then below that portion, we will have things like your taxes paid, dividends paid, etc. Right. This is going to be the same for both direct and indirect method. Now, the section that says cash generated from operations, like we said, is the one where we can prepare using the direct method or using the indirect method. Now, your direct method will require you to disclose cash received from customers and cash paid to suppliers and employees, right? So that is the format or structure of the cash flow statement if you're going to use the direct method. Your cash generated from operations is going to be that amount. The difference between your cash receipts from customers and cash paid to suppliers and employees, then you get your cash generated from operations. So this is the structure you follow when using the direct method. Right. Now, if you're using the indirect method, your starting point to determine the cash generated from operations, your starting point is profit before tax. Then you adjust that profit before tax for non-cash items, right? So you're going to reverse uh, the non-cash items included in the calculation of profit before tax. So they would have affected the final amount of profit before tax. And so what we want to do is to reverse that. And why do we reverse that? Because this is accounting profit. What we want is cash flow, the actual movement of cash. So non-cash items recorded in here, like depreciation, do not represent a cash flow. So we have to make an adjustment for that. Right. Then we're also going to make an adjustment for the items that will be disclosed separately. They are included in profit before tax. They are okay, but we just want to show them in a separate section, not so they shouldn't be part of the cash generated from operations. So that is the reason why we have to exclude them from the profit before tax. Then once we've done that adjustment, right, now we need to, so this is the cash profit, or whatever name you can give it. It's not really important. Then you're now going to adjust for movements in working capital. Movements in working capital. Right. So all the adjustments in trade and movement in trade receivables, movement in inventory, trade and payables, accruals, prepaids, and so forth. Then after all those adjustments in working capital, all right, then we will end up with our cash generated from operations. All right, like that. So we end up with cash generated from operations, like that. Right, so this is the difference. Then from here, we can start with, once we have our cash generated from operations, for both direct and indirect, we can start now putting our taxes paid, dividends received, and other stuff. So the portion from here downwards to investing activities, to financing activities, is going to be the same for all. It's going to be the same for, or rather for both direct and indirect method. Brilliant. So now let's get started into the idea of direct method. So our starting point in a direct method is to start by looking at cash received from customers. Now, for cash received from customers, here is the principle. We start by saying we have trade receivables last year, right? If we are using the, this is the direct method, right? We have trade receivables last year, which is the people who didn't pay us, the customers owing last year. Then we sell some more sales during the current year. This gives us the total that we should receive, because we're supposed to receive from customers owing last year and from sales for this year as well. So we're supposed to receive this amount if everybody pays. But at the end of the year, we can see that there's trade receivables. Some people haven't paid during the current year. So we're supposed to receive this whole amount, but we see we haven't received this amount. So therefore, the amount that the difference was actually received, right? So if we were supposed to receive 100 Rand and at the end we see 30 Rand is remaining, then it means that 70 Rand was paid. Remember that, so when we make adjustments, remember that trade receivables includes adjustments such as allowances. So if there's an allowance for last year, you add it to the trade receivables figure. If there's an allowance for this year, again, you add it as well. And if there is a credit losses written off, that we actually written off, you're also going to add them to the current year. All right. So the current year, you add allowances plus the actual credit losses written off, which are not part of the allowance. So if there is any credit losses actually written off, we add them back, because if we don't add them back, we will assume that was also received, but it wasn't received, it was written off. Here we're looking for what was actually received. So remember the adjustment, trade receivables last year, then you add any allowance for credit losses from last year. The same applies to trade receivables this current year. You add allowance for credit losses current year, plus the actual bad debts written off, the credit losses written off. You also add them back. And remember that our trade receivables can also be, we can be given trade and other receivables like this. So if you can look here, it's trade and other receivables. So we need to exclude the other receivables, because here we want cash received from customers. We can receive cash from many sources, but here we're focusing on that received from customers. Our main business, our buying and selling. How much cash did we receive? So if there's any other receivables included here, we have to exclude them, so that we're going to deal with trade receivables only, not trade and other. So the other, anything else that they tell you is included in the trade receivables amount, in the trade and other receivables, please do exclude it. As long as it is not part of the customers we sell to, we should exclude it, right? Brilliant. So now let's look for trade receivables last year. So that's our starting point. But before we do that, we have to start by reading the additional information, right? So that we can remember which additional information applies to whatever we will be working on at that particular point. And so here is our additional information. The company experienced growth. So the company experienced growth and decided to expand its production of bottles for water. Equipment to manufacture bottles was purchased on 31 October 2022. On 31 August 2020. On 31 October 2022, the company sold equipment for 130,000. The cost price on the date of purchase was 340, and the carrying value on 1 December was 190. Now, if you look at this adjustment, this additional information, it wants us to account for the increase in equipment as an expansion. So we will remember that there is an expansion here. But within that expansion, we need to remember that not everything was an expansion, right? Because there was a sale, right? So we also need to remember this cost price, that it's part of what was disposed, so we have to make the necessary adjustment. And also we need to remember that here we sold the equipment, and because we sold the equipment, we have to record the cash received, not the profit. So we're going to record the cash received, but remember in the accounting financial statements, annual financial statements, there will be a profit or loss on this sale. And if we were using the indirect method, we're going to reverse that profit or loss. All right. We will do the actual adjustments when we come to the portion that requires that. But for now, we just need the awareness to know, if we deal with this, what else should we adjust for? We don't have to read a point there, or rather a section, and then start reading everything to see if there's an adjustment for that. We need to know in advance. So the non-cash items would be reversed in a... So your non-cash items would be reversed if we were using the indirect method. But if we are using the direct method, there's no need for us to adjust for the non-cash items in profit before tax. However, some of these will be adjusted to if we still have the assets with us. We will demonstrate as we go. Then this is the tax paid and dividends paid. That is fine. Then this is the financial assets, which were also impaired here by 20,000. So this 20,000 is going to be important in us determining what actually happened there in the transactions. Then other income, we are told it includes profit on the sale of financial asset and dividend income. Then also so this is 567, all right. So number 6 says there's a fee in 2022. There's a fee for advice that was charged, and this was paid in advance, and the amount is 74,000, right? So we will need this in the payments, because when we deal with the cash flow statement, right, we focus on the actual payments made. Right, we focus on the actual payments made, not on the we focus on the actual payments made, not on the accounting adjustments. So this will not be included in expenses, but it has to be, because it was paid. When we deal with cash paid to suppliers, this is a supplier of advice, right? So they supplied us with advice and we paid. Although it's a prepayment, we paid in advance, we have to include it. And also remembering that it's recorded as trade and other receivables, we have to exclude it from trade and other receivables. Remember, we just want the trade receivables only, not other. And here are the allowances. So we have to add this to the 2022 figure, because if we don't add it, we would think we received that. And we also have to add the 38,000, because if we don't add it, we have a figure that is reduced that will distort the amounts. So 2021, we add 38,000, we add it back. Then 2022 trade receivables, we add 45,000. We also exclude this from the current trade and other receivables. All right, and we remember that if we look here, we look for credit losses, we don't see any credit losses. Because if there were any credit losses included in here, under other expenses, we would have to actually add them to the current trade receivables, right? Because that was not received. If we don't add them to the current trade receivables, it will give the impression that this is part of the amount that was received. So we have to add it back to get the correct amount. All right, now we're going to do the correct adjustments. So for cash received from customers, our starting point is trade receivables last year. And so that's this is 2022. This is 2021. So that's 360,000. Right. Remember, we add that 38,000 from last year because it was excluded. Being included means being excluded, right? Because if you include allowance, it means you subtract the allowance. So we have to add it back. Right. So we add back 38,000. Right. So this is the amount coming from last year, which we didn't receive. And during the current year, we have we sold goods worth 2,100,000. We should also receive this. Right? Do you agree? So the full amount that we should receive is made up of this owing last year plus sales for this year. But you will see that there's trade receivables for the current year, which means that this has not been paid. So the difference was paid, right? This amount plus that amount. Right. So now we look for the trade receivables this year. That's 470,000. And remember that in this amount, we need to subtract the 74,000, which was prepaid, and we add back the 45,500, which is an allowance. So we will have 360,000 plus 38,000 plus 2,100,000, the actual sales. Then we need to subtract. Remember that the amount we're subtracting should be put in brackets so that it's one. Right. This is one amount. This is also one amount. 470,000. We deduct 74, which is a prepayment. We add 45,500. We close. So the actual cash received. So cash received from customers will be 20,56,500. So that is the cash received from customers. Okay. Now we go to cash paid to suppliers and employees. So to get our cash paid to suppliers and employees, uh, sometimes the lecturers, in most cases, the lecturers use general ledger accounts. I don't use general ledger accounts. As you have seen there, I use logic. I use explanations, right? I don't use general ledger accounts. So the logic is our starting point is to determine the purchases, all right? How much was purchased? Because first of all, we would like to know how much was paid to. Right. So we start by determining the purchases because our starting point is to determine how much cash was paid for purchases, right? How much cash was paid for purchases. But before we know how much cash was paid for purchases, we first of all need to determine those purchases. So that is our starting point, right? So this is what we do. So I don't use general ledgers, I use logic. So to determine how much purchases, the first point is to determine the amount of purchases, whether paid for or not, just the total purchases. So you know that we say opening inventory plus closing inventory, right? Right, that's what we do. We say opening inventory plus, this is opening inventory plus, no, what am I doing here? This is opening inventory plus purchases minus closing inventory is going to give us cost of sales, right? So that's how we determine cost of sales. Then, so if we want to get purchases, then we have purchases being equal to cost of sales, right? We want to be left with this one here. So everything crosses there. So cost of sales plus closing inventory minus opening inventory. And you will remember that our inventory could include other things, which is not trading inventory, right? So we have to exclude if there's anything included here, which is not trading inventory, like your your supplies, your stationery, your other office supplies and stuff like that, which would normally be included as inventories. So we need to deduct them here. If they say this also includes the stationery, we need to deduct stationery from there. So if we do like a calculation like this, to say cost of sales plus closing inventory minus opening inventory, we're going to get purchases. Right. So now let's get the purchases. So we're going to say cost of sales. No, it's down here. It's 1,300. This is our cost of sales. So I'm coming here, I'm going to write 1,300, which is cost of sales. Now I need to add closing inventory, and this is my inventory. So it's 1,405. I need to add that. 1,405,000. Then I subtract my opening, which is 1,270. This calculation gives me the purchases. Now, this is not the cash paid for the purchases. This is the total purchases. Right? So I don't use the general ledger, right? But it's the same thing. So 1,300. Right, so let me just say 1,300 and not put the other zeros, plus 1,405 minus 1,270. So my purchases is going to be equal to 1,435. This is my purchases. Now, this doesn't tell me whether I paid for the purchases or not. Right. Now I need to determine, so how much was paid for those purchases. Right. So I'm going to say what I needed to pay last year, that's the trade payables last year, plus what I purchased again during this year, the purchases. These two combined should be what I pay for purchases, right? Then I can see that there's some trade payables which I didn't pay for during the current year. Right? So which means that the difference is what was actually paid. That is cash paid for purchases. Right, that is very important. So we start from, so the first step was to determine all the purchases, whether paid for or not. And then we combine them with what was owing last year. So what's owing last year, which we should pay, plus current year purchases, which we should pay, is the total amount that we must pay. And then we subtract trade payable, still existing at year end, because we haven't paid this. So means the rest was paid. So that's the logic. So let's apply that. So we're going to say trade payables, right? Last year, 940,000. Here it says other payables. So if there were other payables here, like salaries not paid, interest not paid, you would exclude that because we want trade payables. The same principle that we applied for trade and other receivables, we apply for trade and other payables. Right. So trade payables, 940. Last, my apologies. This is this currently. Did I make another mistake like that? Trade receivables. Right. This one got right. My apologies. I must take from 2021. Right. So 626 plus current year purchases 1435. So this combine these two amounts is what we should pay. But now we see we haven't paid 940 at the end. So the rest was actually paid. So 41435 plus 626 minus 940. So we get 1121. So this is cash paid for purchases. Right. Now, once we have cash paid for purchases, now we go to other expenses now. So we're gonna come here. So we have cash paid for purchases. Did I rub it off? This is 1121. So our cash paid for purchases is one. So let me just write. Cash paid for purchases. This 1, 1, 2, 1, 1, 2, 3. Now let's look at cash paid for other things. So we already know that fee paid for consultation, right? So that fee, which is a prepayment, was 74,000. But as long as it was paid, as long as we can see the figure on the bank statement, we're going to include it. So let's look at other things that were also expenses, right? So this is the technique that we use, right? It's an excellent technique, and I'd advise you to use that all the time, all right? Right. So we are done with this and that, and other income is fine. We focus on expenses. This is 230. So other expenses is 230,000, right? But in this figure, there will be adjustments because not everything was paid. It's just expenses. So we look for some things that were not paid. We must subtract them. Yeah. And some things which are non-cash, we must also adjust for them here, right? So we're going to do those adjustments now. So we are given the other expenses paid. And so let's listen to the story. Where's our story? It's here. So non-cash items, 170 and 20. We already know that. So depreciation is non-cash. Right. So let's do the adjustments. So here our expenses is 230, but we must reduce that by 170 because we know that wasn't cash. Right. It's not something you can find on the you won't find depreciation on the bank statement. So non-cash item again, so that was depreciation. Non-cash item, that was impairment, right? And is 20,000. All right, it doesn't come out of the bank account. Then we have a job to calculate, because we are told here, they were very kind to say loss on sale. How much was it? So let's listen to the story of the sale. It's easy. It's really easy. It was supposed to be difficult because 40,000 rand for equipment sold up to date of sale. So depreciation for the equipment sold is 40,000 rand. So the carrying amount of the asset, so the asset was 340,000. Cost is here, the cost price is 340,000. Then we subtract, no, actually we have the carrying amount, so there's no need for cost price. 190,000. Then we subtract depreciation up to the date of sale, 40,000. Right. We subtract 40,000. 190 minus 40, then we get 150. Then we sold it for 130. So there's a loss of 20,000, which we have to subtract here. Non-cash item, loss on disposal, 20,000, right? Now, I want you to listen very carefully here. This is an adjustment we do when we are using the direct method. If we are using the indirect method, we have to add back these to profit because our starting point is profit, right? So these amounts would have reduced profit already because they are included in here. So they would have been part of what was used to reduce profit. Now we want to reverse that. So we have to add them back to the profit. But with the direct method, we are just looking for actual amounts of cash paid. So we have 230, but we subtract these because they were not paid in cash. With profit before tax, we don't start by looking at we start by adjusting the profit first. So we add backwards, right? So, but it's the same, it will yield the same answer. but you need to be aware of that. Right. So what else do we need to work on here? I will tell you something that you need to know. Right. So what you're gonna do here is that with this, you're gonna have to, I want you to listen very carefully. Add. I want you to listen. Add prepaid expenses current year, because these were paid already, right? But they won't be included in other expenses. Remember, a prepayment is an expense for the following year, but we include it because it was paid during the current year. So it won't be part of all these expenses that you see in the income statement, right? You see these expenses here. You won't be able to see them. Right? So which means that when you deal with the income statement, you also need to add, when determining your cash receipts from customers, you need to add. Remember that formula I gave you. I didn't tell you that you must add income received in advance during the current year, and you must deduct income received in advance during last year, right? Because if income was received in advance during the current year, it shows on the bank statement, right? So we are accounting for the amounts that are showing on the bank statement. So if there's an income that was received last year, it's not showing on the bank statement during the current year. That's why we have to say less. If the customers paid in advance last year, we have to subtract it from this year. That amount is not going to show on the bank statement during the current year. So any other expenses here that were prepaid or accrued, we have to account for them as well. So now let's go to expenses. So any prepaid expenses current year, you must add because they were paid. Then we must deduct any prepaid expenses that were paid last year because they do not appear on the bank statement, but they will be included as an expense here. But then they were actually paid last year. So we're looking for the payments last year for the current year only. All right. And then we need to add. So this is for prepaid expenses. Now we go to accrued expenses. We need to add accrued expenses for last year. They must be added because these are expenses for last year, but they should be paid this year. We are looking for payments this year, so we must add here. Not so. And we deduct accrued expenses during the current year because these were not paid. We know they were not paid. They are actually included here under other expenses, but we know they're not paid. So we need to deduct them. This is very important because you will see these things in the exam and you wonder what's happening. So what we have done already is that there's an expense prepaid, this fee, current year, we already added that, right? In agreement with add prepaid for the current year. So please write this down and try to make a little bit of sense. If you can't make sense of it, just focus on the principle given. Right. So let me see here what we have done so far. Right. So we have our cash paid for purchases. Right. Right. That is very important. I was forgetting that there's credit losses. Right. There's credit losses, and these credit losses come from the movement in allowance. Right. So our allowance, did the allowance increase or decrease? Allowance for credit losses. So the allowance for credit losses last year is where's our allowance? Oh, it's given in the additional information. It was last year, it was 38. So there's an increase. An increase in allowance is an expense, but it's not, it's a non-cash item. So 45,500 less 38,000. So you get 7,500 there as an allowance. So this also must also be deducted because it's not a non-cash. Yeah, you won't see that on the bank statement. So if we do a calculation, right? So do you see the logic? I prefer the logic way of calculation. So 1121 plus 74 plus 230 less 170 depreciation less 20 impairment and loss on sale, right? Then we don't have anything else here. Then we less 7,500. So that's 7.5 less 7,5. Right. Then our cash paid to suppliers and employees. So our cash paid to suppliers and employees is going to be 1,207,500. Right. So let's just go to the memo just to right. So this will disclose this as cash received from customers and cash paid to suppliers and employees. We get our cash generated from operations. Now, this is the portion where the direct method is different from the indirect method. From here downwards, it's going to be the same. Now, for those students who are used to following these, what is this thing called? The general ledgers. Right? You have to have a balance from last year. Same thing. You add sales for the current year, then you subtract the balance for current year, then the balancing figure is what was received in the bank account. That's the same logic, but we actually have to, we did say last year plus sales minus that in a direct calculation. And I love the direct calculation because you can agree with the sense that it makes. For example, if you come here to cash paid to suppliers and employees, I'm not sure how many students do understand that, the whole calculation. I think you end up knowing that the balance you put here, the balance you put there, then this is what you do. But what we did is we started by determining the actual purchases. So we said cost of sales plus closing inventory minus opening inventory. These three gave us the purchases, the actual purchases. Then we said purchases owing last year plus purchases this year minus purchases owing, right, at the end of the year, gave us the cash paid for purchases. Then we went to other expenses, said this is the other expenses minus depreciation, non-cash item minus this impairment, non-cash item minus loss on sale, non-cash item minus movement in credit losses, non-cash item. And this was paid. It's an actual movement in cash. So that's how we got this. Right. So that's the same principle. So I prefer using the logic because if there is any adjustments in the question and it's not your standard, it's not clear how to use your standard method of general ledgers, you can always use logic to say, how did this thing, or you can use that expanded formula that I gave you. But whatever you're comfortable with, at the end of the day, you must be able to collect the marks. Right? Brilliant. So now we come to the portion where we have to look at other operating expenses, payments that we made, payments and receipts from other providers, right? So that has to do with tax paid. That is easy, right? Tax paid is very easy. That is very simple. So we have to say tax last year, all right, plus tax expense this year minus what's still owing. So that should be straightforward. So that is the tax paid, right? So that's that should be straightforward. Then dividends paid, dividends payable, right? So we have 95 from last year, 75 this year. We subtract. Then where is the dividends declared? Do we have anywhere where we are told that there were dividends which were declared? I don't know. Do you guys see anywhere where it says there were dividends that were received? Because normally we would need an additional statement of changes in equity that shows dividends declared for the current year. Um, Dividends payable. So we have 95. So far, if we owed 95 last year and we owe 75 this year, it means we paid 20,000. So is there anything else that was declared? Oh, the total amount of dividends paid for 2022 was 140. So this is the total. We don't have to do any calculation, all right? All right, that's fine. So we're just going to plan in 140. Then dividends received. So we start from dividends receivable last year. They would be under, maybe under trade and other receivables. Remember, we would, if the dividends to receivable last year were, or rather, if the dividends receivable are included under trade and other receivables, then we have to exclude them because we want trade receivables only. But now we're looking for dividends received, right? Why am I so old? So this is done. Um, the total amount of tax paid is also given. Other income consists of profit on sale of financial asset as well as dividend income. Oh, so we have to determine the profit on sale of financial asset first, then the balance is the dividend income, right? So that's going to be not too difficult. Profit on sale, where is it? Financial assets are held within the short-term profit making. So this means that they will be part of the operating activities. The financial assets, if they are held for short-term profit making, they're part of operating activities. If they are held for long-term investment strategy, then they're part of what is this called? Then they are part of investing activities. So an investment was sold for 210, making a profit of 30. So this profit of 30,000 should be removed. That's going to be our dividends received, right? So 320 minus 30, right? So that's straight for 290,000. So proceeds from the sale of financial assets, we are also told that is 210. So we're going to just put it there as income. Then now we need to do, sometimes we need to do a calculation of these guys, of the financial assets. Now this is more, the calculation of financial assets is more like the calculation of PPE to determine how much was actually added during the year. So we will also look at how to calculate that using the general ledger. But like I say, I prefer the the logical approach. Makes a lot of sense. If things can make sense, then it's going to be difficult for you to be dribbled by the examiners. So financial assets last year was 840,000. Do you agree? Right. So we have financial assets, 840,000. Right. then what happened is, then if you look at the transactions affecting financial assets, we have impairment loss on financial assets. So it's 20,000. So this should be reduced by 20,000. So if we reduce this by 20,000, then we get a balance, right? And then, so we reduce by 20,000. Then we are also told that financial assets was sold for 210, making a profit of 30,000 rand due to market fluctuations, right? So what happens here is that the original cost was 210,000, but minus 30,000. Right. So the original cost was 180,000. Not so. Because if we sell something for 210 and then we make a profit of 30,000, then it means that the carrying amount of that thing was 180. So the carrying amount is the amount at the beginning of the year, right? That we had. So it means that it had a carrying amount of 180. And if we sell it for 210, that's how we can make a profit of 30,000. So this something which had a carrying amount of 180 at the beginning was also removed. So we come and remove something with a carrying amount of 180,000. Right? Right. Right. So now, which means that what do we have here? Right. So, which means that if there's nothing else that happened, we must have 840,000. Right. We subtract the 20,000. Right. And we subtract the 180 which we sold. Right. So our balance should be 640,000 at the end if nothing happened. But now if you look at the balance, it's actually 920. So which means we bought some more to reach that 920,000. Because if there's nothing to be done, we started at 840, we reduced this by 20, we reduced this by 180, right? So we should be at 640. How come we are at 920? So there were some which were purchased. So we said minus 920. Then you can see that it's 280,000 which were purchased. All right, so we purchased financial assets worth 280,000. So this is the logical approach, right? And you can also use the logical approach when dealing with any sale and depreciation of equipment. You can PPE, you can reason, right? To say this is our starting point at the beginning of the year or last year. So if we do all these transactions, we should be here. But you see that the balance is different. So it shows you that something else was added. Right? So if we go to the answer, so now we have our dividends received, dividends paid were given, the tax paid, proceeds is given, and this is our calculation held for trading. Right? So if you want to do a proper general ledger, so you start with this balance 840, and then we removed 180, right? The carrying amount. Then we removed 20. So we are left with 920. So it means we added 280. So this is the same logic that you can also do using the the general ledger. Now let's go to, so this, where are we now? Right. So now we can say this is the net cash from operating activities. That is what we have. Also, don't forget the brackets. For an outflow, it's then bracket. So this is an outflow. It's an outflow. It's an outflow. For an inflow, you might choose, we should use rather, let me say, you just leave it as it is. Now let's talk about investments, right? Investing activities has to do with non-current assets. Those things that you put in under your non-current assets, you've property, plant and equipment, and financial assets, right? So we're going to sell all the disposals are going to include it here. We're going to buy. And then when we buy, we distinguish between investment to expand production capacity or investment to maintain capacity, right? We distinguish between that. So we need to know whether this is an investment to expand or to maintain. So we start with the proceeds from the sale, which is very simple. Proceeds from sale, this is operating. So there's that proceeds from sale, which is 130. So we sold for 130. The actual amount received. Remember, the only time we include this proceeds is when it was actually received. Sometimes it's received, sometimes it's sold for 130, but you receive like 100 rand for now. And this 30,000 becomes part of trade and other receivables. So we need to be careful there. You don't always include the full selling price, right? Right, so this is what was sold, 130. This is actually the cash received. Is there something else that was sold? Right, so for our um, right, for our PPE, let's do an accounting for PPE. Well, let's start with land and buildings. So land and buildings, we'll start with 300,000. This is land and buildings. So let's look at any transactions that happened here. So this is the equipment. A portion of land was sold to the business operating next to amounts at valuation amount. Right. So, right. So it was 1.3. We are now at 1972. Right. So let's look for more information. Let's look for, because it said here, when it says it was sold at valuation amount, I believe that it was sold for no profit or loss at the carrying amount. But now I need to check for um, I need to look for any guides, right? In the absence of an immediate guide, we should be able to figure out what happened. Okay, brilliant. There was a revaluation surplus on land, right? That is the guide. So our land actually grew from 1,570 to 2,250. Right. So this is the revaluation surplus. So 2,250 minus what? 1,570. So the revaluation surplus on land, the increase on the revaluation surplus is 2,250, right, minus 1,570. So the increase in the revaluation is 680. So as a result of this revaluation increase of 680, we start with 1,300, then we add 680. So our balance should be 680 plus 1,300. So our balance should be 1,980, right? Did I do this calculation correctly? Right, we have 2,250 and we subtract 1,570. So that's an increase of 2250 less 1570. Yeah, that's 680. And if you add 680 there plus 1300 just to cross check, then it gives us 1980. Right. My apologies. Why aren't you helping me? I'm looking at retained earnings, and you guys are quiet. I'm thinking there was a movement in the revaluation surplus from last year to this year, but this is not. The revaluation surplus is 1.1. So we start at 1.3, right? Right. And we add 1.1. Right. So our value here, then we see then that we should be at 2,400, right? 2,400. That should be our balance, right? If we start at 1.3 and add 1.1, we should have 2,400. But now our balance is only 1972, right? So we're going to say 2,400 less 1972. So we see the portion that was sold is 428,000, because we're using logic to say if we started with 1.3 and we add 1.1 more, we should be here. But why are we here at 1972? We are told a portion of the land was sold. So the portion sold is the difference, 428,000. You can use the general ledgers as well. But the same applies to the same applies to equipment. We use the same logic. Right. So what's the land here? The plant and equipment. Right. We're starting at 1850. Not so. Start at 1850. And then what happens here? So we look at the transactions. Our year is 30 November. So this is 30 November 2021. So we're looking at 1 December to what? To 30 November 2022. Right. So we're starting at 1850. So let's look at what happened during the year. So during the year, and if you look here, this would easily be your what? Your carrying amount, right? So we'll start with the carrying amount of 1850. One December 2021. So there's a carrying amount of 190. All right. Included in here, this was removed. So we removed that 190. The whole 190 was removed because it's sold. Right. And the other depreciation for the rest, because the 190 is the carrying amount of what was removed. So we remove it together with all the depreciation that was remaining. Now the depreciation for the rest is, for everything including what was sold, is 170. So we say the depreciation for the rest is 170 minus 40. So we also subtract that 130, right? Depreciation, 130 depreciation. We also subtract that. So what we're doing here is that the carrying amount is where depreciation is calculated from, right? So this carrying amount has been removed completely. So it won't be part of the carrying amount at the end of the year. And now, because it's removed, we need to focus on the depreciation for the remaining, which is 130. Now, if we remove that as well, we should be left with 1850, right? 1850. We have removed 190 carrying amount. Then we also removed 130 depreciation on the remaining. So the carrying amount should be 1530. Right, but we see here we have a balance of 2170. Right? So we have balance of what balance do we have here? 2170. So we should be having 1530, but we actually have 2170. So which means that this is the additional that we bought. 2170 minus 1530 gives you 640,000. This is the amount we need for expansion. Right? Right. So where do we go? To the final answer. So we have these proceeds from the sale of assets. We have combined them. Investment in investment to expand production capacity, this 640. We could also have here investment to maintain production capacity. If something was bought to replace, they say it was bought to replace this, then that is what we have. Then this is the net cash used in investing. Then cash flows from financing activities should be easy because we just look at the financing section. Ordinary share capital. What happened here? Was there anything to say there was an issue? Revaluation is out, retained earnings. Long-term borrowings from this to that. All right. What are they doing here? Are they crazy or what? What do they smoke? Because you can't give us a total like this. This would be stupid. You can't give students a total and expect them to calculate a missing figure. So let me just try to check that if there is any wisdom there. 7077 700. Then I subtract everything here. I want to see the balancing figure here. I'm going to subtract 100. I'm going to subtract retained earnings less 2250. I'm going to subtract 548700. I'm subtracting 64,000. I'm subtracting 75,000. I subtract 940,000. So it's still 2.1. So which means that there's no change. So there was nothing issued here. That's a waste of time, huh? Then long-term borrowings was 1 million. Then we subtract 548700. So this is a repayment. 451 is going to be a repayment, right? 451,300 is going to be a repayment. It's in brackets. So that's cash. And this is not cash, net cash from, but net cash used in financing activity, not from. All right, used in financing activities. Right. And this is the increase, right? We started with, so here's 824 plus that, minus that, minus that. So net increase in cash and cash equivalents, that cash and cash equivalents at the beginning of the year, then cash and cash equivalents end of the year. This was an overdraft. That's why we subtracted. Right. Then it should also give us 14700 as the cash and cash equivalents. Right. Right. That is where we are. Now, if you want to do a quick right, a quick scam, do you know a scammer or pickpocket? If you want to do a pickpocket, a quick pickpocketing, you know, the easy way is, but that only works, the pickpocketing works if the pockets of the examiner are correct. Like here, you could start. This is what you could do. Let's say you don't have sufficient time. You want to do some quick pickpocketing, right? You could start here, right? And you could start here, right? And say cash at the beginning of the year 150, cash at end 140. Then if you combine those two, it must give you the increase, which is 290. So you already have these marks, right? Quickly. And now because you can do a quick calculation on cash flows from financing activities, there's that amount. And you can also do a quick calculation on cash from investing activities. That's straightforward. You get those two, right? So this, if you balance upwards, this will give you this amount, right? And you can do a quick calculation here, and you can do some calculations, and you put an amount there. This amount that you do calculate here may not agree here, but that's why I call it a pickpocketing. If an examiner just goes through your work, they will wonder where you did make a mistake because your answers are correct. So they will think you made a mistake somewhere, but you an excellent student. Right? So if somebody is not checking, you can pickpocket here the marks. You can start from here, add backwards. This is easy to get. This is easy to get. Then this leads you directly to this amount. So you make mistakes there and there, and you get this, right? Or you can also use it as a way of checking the correctness of your calculations here. That is, if you have the time, let's say you are practicing, but in the exam, you seldom have the time to check if your answers are correct. You should know these things from the beginning. Right, then finally, just a quick look at these things. Planted equipment, general ledgers. We started with 1,850, right? Then we sold something. We removed 190. You remember? Then we removed also this 170 minus 40. We removed this. We removed 190 and also removed the depreciation. So we should be left with, so the balancing, we are left with 170. So the balance is this. So that's the same thing that was done to land and buildings as well. We started with this and we added this, but we see we have a balance of this. So the balancing figure is what was sold. Right. So I hope you guys have enjoyed this. All right. I hope you enjoyed this. So if you have any questions or if you would like to join tutorials, you can always, or if you would like some accounting services and tax and accounting services, whatever your needs, you can always WhatsApp this number and then we can always assist you. If you want tutorials for this year or for next year for anything, always inquire just to give an idea of whether we can assist you or not. But thank you very much and good luck with your preparations. And remember to subscribe to our channel and also encourage others to do subscribe because they can benefit themselves. You know, something's there for free. You just go through it and could possibly make a difference, which is what we hope for. All right.